All right, now, as at today, if you want to take a commercial mortgage in Nigeria, the current interest rate per annum is between 26 to 30%. So on average, 28%. Now, that's an extremely high interest rate. And a couple of times when, particularly Nigerians in diaspora, when they want to buy a property and they're looking at mortgage funding or mortgage financing, and we tell them, we look at the criteria and everything, and like, okay, everything is good. And when we get to the interest rate, we tell them, oh, it's 28%, it's 26%. I'm like, really? Are you guys serious? That's too high. Here is 3%, here is 6%, here is 7%, blah, blah, blah. All right, so interest rate at 28%. Why? Basically, why is interest rate at 28%? And we are going to be looking at the factors behind that, the reasons behind that, and the obstacles that's provided or that is providing, and also the opportunities that is providing also. All right. So in case you are coming across a video like this for the first time, this meet the Property Guy Property channel, and this will discuss everything real estate for first-time investors, avid investors, real estate enthusiasts, people who are interested, curious about buying real estate, investing in real estate, investing in real assets. We discuss about everything about that here, and we have playlists for you, shortlets, playlists on off-plan real estate companies, and so on and so forth. You can watch any video, several videos under any of these playlists, and you are definitely going to love it. It's never going to be a waste of time. All right, so let's go straight into the topic. Interest rates at 28%. Why is that happening? All right, so we have a simple table here, and I'll be explaining quite a couple of things that a lot of you guys don't know before. All right, now we have MBS. MBS is just like mortgage-backed security. That's what we call MBS, mortgage-backed security. All right, so then we have the mortgage bank. We have home buyers or off-takers. Some people call home buyers off-takers. We have developers, and then we have home buyers off-takers also. All right. Now, we are just going to be looking at how all these interest rates get to be generated, how it gets to affect home buyers, who determines this interest rate. Is it the bank? Is it the developers? Is it whatever it is? All right. Anyway, now starting from like January, Nigeria's interest rate have been constantly increased. The MPR by CBN, the monetary policy rates have constantly been increased. This year, something base point, blah 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 base point, and then went to 22, went to 26, and so on like that. So that's also like a big factor to whatever the interest rate is going to be doing, and that's still because a lot of our mortgage financing is still coming from a lot of funds from commercial banks, and the mortgage banks really might be the one you are talking to when you want a house loan or a house financing, but it doesn't really necessarily mean that the money that finance that house purchase is coming from the bank. You understand? So the money that there is also people that finance and fund mortgage bank. There's also a time that we had NIMC. No, not NIMC. Sorry, NMRC. Nigerian Mortgage Refinance Company Corporation, yeah, NMRC. So we're also trying to create mortgage refinancing in Nigeria right now, also, so that mortgage banks can be able to finance more people. Because this is what happens: if a mortgage bank has, like, let's say 1 billion, their liquid cash 1 billion, and there is a house of like maybe 100 million, and then 10 people come to the bank that, oh, I have a house of 100 million, I want you guys to finance the house for me. And the mortgage bank finance for the 10 people. Automatically, the mortgage bank have run out of cash because they have financed all the 1 billion that they have to like the 10 people that have applied, and now they cannot finance anybody again, basically. So what happens is that as the mortgage bank is financing houses, the mortgage bank are also creating investments around those houses that they have invested or they have financed. So they are going to sell this investment to investors. So what this means is that after the mortgage have spent that 1 billion to fund and to loan different house buyers or home buyers, the mortgage will now go to investors with the property, the mortgage deed that they have, that, oh, there's a house at so place that you have financed, there's a house at so place that you have financed, there's a house at so place that you have financed. You give us 100 million, you give us another 100 million, you give us another 100 million. So now the mortgage will now raise another fund of those amounts that they have already financed or they have already loaned out. You get? So they raise another 1 billion and they use those assets that they have mortgaged already as a security for investors. So the interest rate that you are paying to the bank is not really going to the bank. The interest rate is going as a repayment to, like, as a profit or the ROI to investors that have bought the mortgage-backed security from the bank, basically. So which means that if mortgage bank are charging, like, let's say maybe 28% or 26%, if they can get, or they can sell an MBS, that's mortgage-backed security, at let's say maybe 16% or 15% or 14%, an investor buy that mortgage-backed security from them too, they can reduce their interest rate to like maybe around 18 or 17 or 20%. And mortgage banks, they do that a lot. There'll just be a time they'll just tell you that, oh, for the next 30 days, we can bring down our interest rate from 28 to like 20 or 18 or 17. That's because they have been able to raise a particular fund at maybe 14% or 12% interest rates for them to like be able to finance those houses at that rate. Hope you get it now. So mortgage banks are funded by MBS, mortgage bank security. So this mortgage bank security is not a corporation, it's not a company, it's not even an individual. So it's pool of different funds. It's pool of different funds from different investment companies, from different investment funding, from different investment vehicles, investment channels that are now come to the bank, the mortgage bank, which they can now use to finance. So because the mortgage bank are not financing with their own fund, they are financing with the mortgage bank, mortgage bank assets or mortgage bank security, they always have liquid cash to fund more customers. That's the model. That's the entire idea. So the reason why our mortgage is not really working is because most of our mortgage banks don't have money. We have like 20 million housing deficits. Let's say an average house is like maybe 10 million. Average house of 10 million. Multiply 10 million by 20 million. That's like the capital needed by mortgage banks to fund and give out loans. Our mortgage banks don't have that money. And if they receive maybe a 1% or 2% of that fund, the interest rate that investors are expecting is pretty high, which also have to take it down to the interest rates that they are going to give home buyers. All right, now mortgage banks are not only financing home buyers, they are also financing developers. And whatever interest rates that mortgage banks are giving out to the developers is also going to trickle down to what developers are also going to be providing for home buyers or for off-takers. So if developers are already picking funding and financing from mortgage banks at 20%, 22% interest rates, that's also going to go into the prices that are going to be selling the houses for home buyers, and as well as the payment plan or payment terms that are also going to be offering home buyers too. So at times when you look at developer payment plan, they say, okay, pay within 6 months at so amount, pay within 12 months at so amount, pay within 18 months at so amount. It's because as they are selling to you, that project is also financed and funded, and whatever interest rate that the bank are charging for 12 months, for 18 months, the developers have to transfer that interest rate to you. So that's why the property can be like 60 million, and if you are paying within 12 months, the property is 80 million, 10 million interest. Because the funding also that is also coming from the bank, they also have to like pay that interest on that amount too, which they have also factored into the extra interest or the extra charge they are putting on that price. You get? So mortgage banks are financing both home buyers and developers, and whatever this interest rate is going to affect both of them. Now, developers also receive funding from MBS, and that's what a couple of developers have been doing for a while now with all these Landvest, RealVest, this one Vest, Ontario Vest, whatever Vest, or real estate cashback, or real estate buyback, buy to resell, buy to this, that a lot of companies are doing. They're just creating a security or an investment vehicle where they can receive funding and bypass the bank basically. But again, there is trouble because a lot of these MBS that developers are selling, they're offering 35%, 30%, 40%, 50% return on investment on 12 months, which means that they are even offering a higher interest rates than banks. Basically, they are offering a higher interest rate than banks. So you are giving a developer fund and you are expecting 35% within 1 year or after 1 year. You are giving a developer fund and then you are expecting 40% or 50% within 1 year, and you want to buy a property. You understand? You want to buy a property and you want a lesser interest. It's not going to work that way, because the profits or return on investment developers are offering you is also going to trickle down to also what they're also going to be selling to home buyers. So if they're already offering 40% return from the MBS they are collecting, the land verse, the real verse, the whatever verse, they're offering 35%, they're offering 50% for the MBS, this mortgage-backed security or whatever security that they're already receiving from investors. They're also going to add that interest to what they're selling to home buyers. It's just as plain simple. And for a lot of our Nigerian investors, they don't want to do any long-term investment, even if it's equity or crowdfunding or investment securities. You understand? A lot of investors only want to do investment security of like 6 months, investment security of like 12 months, which will not help developers. So not help developers, because the housing and house financing, the longer the payments or the repayment period, the cheaper it's going to be and the more affordable it's going to be for home buyers. So if you as a Nigerian diaspora also want to buy a property and you want like 5 years payment plan, you want 8 years payment plan, you want 10 years payment plan, then you also must be able to be willing to join an investment vehicle or investment security where whatever cash or whatever fund that you are giving them can stay with that developer, let's say for like 7 years, for like 6 years, and maybe you are just collecting dividends from that developer. Which is like a lot of the challenge that I'm looking at in the industry, because I'm looking at the industry and I look at you are being funded for a development, a project, a construction project, and you're already pledging the assets on 40% return on investment or 40% interest. Let me put it that way: 40% interest, 35% interest, and add inflation to the equation, add the exchange markets to the inflation, and you are as a developer, you're already like looking at around 70%, 80%, or you just going out 30% or 40% to 35% to investors, around like maybe another 20% or 25% to inflation, another couple of percentage to fluctuations in the exchange market, and you realize that that's why price of properties just go from like 60 million to 120 million in a jiffy. You know, because there are a lot of behind the scene here from the funding that is coming to the developers, the funding that is coming to the mortgage banks, and the person that or the people that are going to like face and suffer this the most are the final off takers, the home buyers. You know, the home buyers. So whatever interest rate that you are collecting from developers and you are like smiling to the bank on it, you're also going to pay for it directly or indirectly, because whenever you want to buy a property also, you're also going to like also pay part of whatever percentage, 40% or 30% that you have already collected too. So that's what is really happening. So if you're looking at our interest rate for financing, for funding, like that 28% rates for mortgage financing, and you're looking at the payment plan for houses, are looking like payment is 3 months, payment is 6 months, payment is 12 months max, and you're like clamoring for 3 years payment plan, clamoring for 5 years payment plan, you need to understand that there are quite a lot of things wrong with our market, and it's not just from singling out these people, the developers, but we also have to look at different sections and sectors of the market, the mortgage banks or the commercial banks or whoever is financing, the mortgage-backed security that is also going to the bank, and so on like that. So, which means that if we can create a mortgage-backed security, for example, and you can put in like maybe like 2 billion or 3 billion as a like a security investment, and you are able to pledge this fund to like different construction projects, different housing developments at, let's say, maybe 16%, 18% interest per annum, then this will also trickle down to also what developers will also be selling to off-takers. As simple as that. The market is ripe, but it's all about who is going to be willing to offer that kind of interest. You know, because a lot of people are constantly looking at short term, and to be very frank, it's not going to make sense to any investor to offer like 16% or 14%. When you look at, if I convert my fund back to dollar or to pounds, my fund is already useless. But what will start to now make sense is if I'm collecting my return on investments via dividends. So I'm dropping like maybe 3 billion, and I'm charging like let's say like maybe 5% or 2.3% or 2.5% or whatever percent on that particular figure for as monthly repayments. You know, so it's not like about getting my 300 billion back now. It's about the yield the 300 billion is going to give me if I do like a 10 years financing. You know, I do like a 15 years financing. So it's more about the dividends for me than just quick flip. I put in my money, I cash out. I put in my money, I cash out. But my equity will guarantee me like a monthly dividends, an annual dividends on that particular amount on so particular percentage. And if I have 10 years dividends on that particular investment, as a developer, I can easily also sell the property to home buyers, to off-takers, and do a 10 years repayment and just shift the entire interest on the dividends to home buyers. So as home buyers are paying me, I've charged that interest on what they are paying me every month, and that interest is going to my investors as dividends to them every month. So there are quite a number of investment vehicles that you can build around MBS that is still really lacking. And the housing crash that happened in the US around like 2006 or 2007 thereabout is all because of MBS. So a lot of mortgage-backed security were like bad investments, and those investments go off. And a lot of countries have been buying mortgage-backed security in the US for a number of years. So a lot of their assets just went off. So we'll be doing a lot of these. We'll be doing a lot of analysis on investment vehicles now, because we have quite a number of products that we are building around these: financing, funding, equity ownership, co-ownership, crowdfunding. You know, we are just looking at easier ways to liquidate real estate assets. You don't really have to now start looking for agents to talk about because you want to liquidate an asset, you want to convert it to cash, but because you have put those funds in assets that are faster and quicker to liquidate, you can make your money less headache. There's a financial emergency, you're not running around, and so on and so forth like that. All right, so if you have questions about these, or you have something to throw in more about this, because I know a lot of you guys also have mortgages or have bought mortgages and understand how some of these things work, you can drop your comments, give us your analysis, give us your own explanation. Also educate us on some of the things that you feel like we are missing, also that we really did not introduce in this permutation, and you can share ideas and share perspectives on that. All right, so if you're also looking at different investment vehicles that you can tap into in our real estate market, also I'm very open to that. There are a lot of models I'm building right now, and the more the merrier. So it's quite open to investors to come in at different level of the investments package or the investment vehicle that we are doing. All right, so if you have been enjoying our videos, kindly do subscribe, share our content, give us a thumb like. Also, don't forget, give us a thumb like. If you are doing these videos, you guys are not watching it, they are just a waste. So we appreciate you guys, we appreciate your time here. So I see me, your number one property on the planet, Rabi Mustafa, that's the name. I'll see you next time.